Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, November 16, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And you almost have to laugh a little bit when you take into consideration the fact that this is options expiration week, and I know it may sound a little bit esoteric. However, the market yesterday closed below and was trading all day below the 20-period moving average on the daily chart. Just think for a second how many inexperienced or retail traders bought puts thinking this was the correction that they've been waiting for. And today, all of a sudden, out of the blue, the market rips higher, opens above the 20-period moving average, and trades higher for the majority of the day minus the last, let's say 40 minutes of trading or hour of trading, whatever it was. So the point is that this is, in my opinion, the way that the options desks at the institutional trading firms, whether it be Morgan Stanley, Goldman Sachs, UBS, the list goes on and on and on, hedge funds and the like. It's the way that they make money on the week of options expiration week. Their objective is to make sure that as many options expire worthless as possible. If there were a lot of puts purchased by retail traders yesterday, for example, or even this week, whatever it was, or previously, and they were due to get paid off if the market stayed down where it was yesterday, they didn't get paid off, or they won't get paid off because most likely the majority of them covered. That was some of the early buying, which was panic buying, and short covering, which drives the market higher. And then buying begets buying, and the market basically had a trend day up until we topped out and started pulling back in the latter part of the afternoon session. So that's, in my opinion, what was going on here, but you have to laugh. Yesterday, we talked about three options. There's always three options: higher, lower, or flat, right? That's not a revelation. However, option A was, and I was reminded of option A this afternoon by one of the members, it was option A today. Option A was we just take back everything and we trade higher, and that's the end of it. And remember, we discussed the fact that the only way that the market was going to get into correction mode was a close below yesterday's low. Well, we went the other direction. That was option A last night. We opened above the 20-period moving average and continued trading higher, and that puts the market right back in the same position it was the day before yesterday for all intents and purposes, and before that. We're in an uptrend. We're above the moving averages. We had a one-day wonder below the 20. We never confirmed below. That's very important. Confirmation is ultra important, or uber important, because we didn't confirm below. You needed a close below yesterday's low in order to confirm that some kind of correction was underway. Now, it may happen tomorrow or next week, but for now, it's taken off the table. We're back into the same position we were before. Obviously, the market could trade back down tomorrow or the next day or whatever it is. That's fine. We take it one day at a time. We just read the charts based on today's activity and what the market or the chart is telling us. And right now, the chart is in the same position it was before yesterday's one dip below the 20-period moving average. It's in a bullish formation above the moving averages, and that's the way it is right now. Let's go over to the IWM, because this was a pretty unbelievable rip higher. The IWM was up about 1.5% today. Remember, we discussed that a support level was going to be somewhere around 144 to 144.50. Yesterday's low was 144.50 on the button, I believe. Just double check. 144.50, and today the IWM was up over $2 right into the 20-period moving average, backed off a little bit, but closing back above the 50-period moving average. So at least for the time being, that's a positive development. Is it going to stay up here? Who knows? This is how we tell. We tell when and if the IWM is able to close above this breakdown candle. If it does, we go back into bullish mode. If we can't, technically speaking, this is still a bearish pattern that could have more downside coming. Now, if the IWM were to come down again after the type of bounce or rally we had today, the odds favor that this is no longer the same type of support level, nor is this green line here, that it was the day before yesterday. Okay, we came up short of it yesterday, had a nice $2 plus bounce today. If we came back down, we would likely come down with more velocity because we came up short, took a deep breath. Think of it as the market taking a deep breath, and then if it's going to exhale again, it's likely going to exhale and go lower than we would have found support if we found it yesterday around this green line or even the 100 period moving average. That's the way I see it. That's the normal way the market works, common and normal market behavior. Right now, we don't have to worry about that. If we begin to come back down, we'll discuss it again. But as for now, the market had a big up day. Same routine as the spider with the options. There was no doubt that there were a lot of options bought on a lot of markets across the board. And when I say options bought, I mean puts bought. The actual bet that you want to make if you're an options trader, okay, you want to be on the same side as the institutional traders. The majority of the time, the institutional traders are selling puts and selling calls. That's the better bet. Time is on your side. When you buy a put or buy a call, you have two things working against you. You have time and you have the erosion of price. If you don't nail the price from a timing perspective correct, the option and the time premium works against you in two ways. So when you sell a put or sell a call, you have a little bit of an advantage because the time premium is working in your favor. As the put or the call gets closer to expiration, it gets less and less valuable or it gets devalued. And that's the way it works. So when you buy a put or buy a call, you're typically selling them to the institutional folks. Remember, there's always two sides to every trade. Let's go to the transports. The transports finally had that rip higher that I was discussing a couple of days ago. I said that after that 21st day down, it would not be uncommon. In fact, it would be likely that we would get a nice big rally off that level. And it went down for another couple of days, went sideways for a couple of days, and then yesterday we went down. But today we made up for it by going up about 150 points or over 1.5% in the transports. So the question is, was this a bottom on the transports? It's right in the middle of the two support areas that we've been discussing. So we had support area number one, support area number two was down around the 200 period moving average, and we came in right in between. That's the way the market works. Never gives you exactly what you want, makes you guess a little bit, but we had a nice rally off that level and we closed back above the 100 period moving average. The question is, are we going to see follow through in all these markets? The question is, are we going to see the follow through or are we going to see failure? And with it being options expiration week, don't be surprised if you see at minimum of a retracement of today's move tomorrow in all these markets. Okay, that's a minimum. That's likely what's going to happen. Again, some people have puts and calls. Some people that sold their puts today, they may have bought calls. Well, guess what? The institutional traders are going to want to make those calls expire worthless. The weekly calls is really another casino on the side. And each and every week on Fridays, not only do you have the monthly options expiring tomorrow, but each and every week you have weekly options expiring. And those are basically traders that are gambling on weekly options. And those are also the ones that the institutional traders will whip around and try and make wherever the preponderance of those options are in terms of strike price, make as many as they can expire worthless. So don't be surprised to see a retracement downward in all these markets tomorrow, being Friday on options expiration week. That would also be common and normal market behavior. But most of that would normally take place in the first 90 minutes of trading. After that, unless there's something going on in terms of political or geopolitics or something in the Middle East or anything like that, the likelihood is on a Friday, you're likely to see the market get very quiet and have that Friday float. Going over to the gold market, nothing happened in the gold market today, pretty much flat. So we don't have any new information to derive any kind of a forecast from, or anything the chart is telling us that it hasn't been telling us. And basically what it's been telling us is the likely story is it's a bearish pattern that wants to go lower unless and until we can close above on first hourly and then daily basis. Really, this is your first line of defense where the overhead resistance will be. If we can close above that level, then we likely go and fill the gap. Unless that happens, the likely direction for the gold market, it seems to be down out of this bearish wedge pattern that's developing. That's what will likely happen out of this pattern. But of course, we're going to go and talk about silver one more time. And silver is telling a little bit of a different tale. And it's the flip side, meaning, and I'm not telling you anything new, but I'm just reiterating, until and unless we close below this candle or even this candle first, this is a bullish pattern that really wants to go higher. So we do have a divergence in the metals. One of them will win out. I've been saying this day in and day out. One of them will win, and when they do, whether gold goes down, silver will follow in that direction. If silver goes higher, likely gold is going to follow in the upward direction. So nothing's changed in gold and silver. We can move it along to the crude oil market. Now, crude is finding somewhat of support so far around the 20-period moving average. Price came into home base. You know, I like to call the 20-period moving average home base. So therefore, we're beginning to create or develop what looks to be, at least from today and yesterday's perspective, potentially a bearish pattern. If that develops for another few days, then we're going to go lower in crude oil. But right now, there still would be a decent amount of support at this low here at 54.59, okay? 54.59 is the low of this green candle. Also, this consolidation area wasn't all that much of a consolidation area, but nevertheless, this is still a decent area of support. If broken, we're going to come all the way down and want to test the secondary or the second to last green candle or green up breakout candle, which is the, I have to get rid of this stuff, comes in at 52.44. And ironically enough, that also coincides with right around the 50-period moving average. So here's your two levels in crude. I don't think there's a short trade here right now. That's not what the market is telling me. The market is telling me it's still in an uptrend, at least above all the moving averages. It still can go higher. We were just overbought. The market put in somewhat of a tail candle, pseudo doji candle, now is coming down, but it doesn't mean that it has to come all the way down. It can certainly mean it's just working off some of the overbought condition, came back to home base, which is the 20-period moving average, and we'll see what develops from this point forward. If we go sideways right around the 20-period moving average for another 2, 3, 4 days, then I would suggest that the likely direction would be lower. But until and unless something like that happens, right now, it's still really in an uptrend, and I wouldn't be long, I wouldn't be short. It's not really giving us a signal one way or the other. In the bond market, we had somewhat of a reversal today. So we had a big down candle closing below, or it's not officially closed yet, but we're below the 50 and the 100 period moving averages, although they're not that important as a result of the fact that we've been trading back and forth through them too many times, which diminishes the importance of the moving averages. But this doesn't take off the ABC pattern. It doesn't take it off the table. It's just one day that really corrected yesterday. And what was interesting was that yesterday the market was up pretty large when the stock market was down, and today the stock market was down and the bond market was up, and the bond market was down pretty large. So you can see here they're almost back in sync. Maybe not each and every day, but they seem to be, at least for the near term, back in sync in terms of the bond market. So we'll see at bond market to stock market in terms of a correlation. I don't love correlations, but the bond market and the stock market certainly do have a correlation. When money runs out of the stock market, it has to find a place to go, and it generally flows into the bond market. So if this ABC pattern is going to play out, that may mean some more downward pressure for stocks. We'll see. Little too early to tell. But the ABC pattern that is developing in the bond market is certainly not off the table. It's not a complete reversal candle, but it certainly has the makings of a reversal candle. It's not tremendous volume. And if we actually finish the official finish of the day, if we finish down near the lows of yesterday, then that would be a reversal, and the likelihood would be we would go lower. We'll see what happens, though. It's still an active ABC pattern as far as I'm concerned. The dollar had a little bit of an uptick today. Yesterday, we bounced off that important level, 93.365, the 100-period moving average. Today, we're up a little bit, a touch. No big deal one way or the other. The interesting story is, and what's important is, that this bullish pattern is still intact. We came down to test the low. We tested the breakout point, the low of the green breakout candle. That's what markets like to do. They like to test former breakout and former breakdown areas. That's what we did yesterday. We bounced off that level, and now we'll see if we continue higher. But nothing has changed from yesterday's discussion in the dollar. A nice bounce off that level yesterday. And that's everything that I wanted to and intended to discuss tonight, so I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.